Around the world, central bankers are grappling with the tricky prospect of bringing down inflation while keeping the economy afloat.
Inflation has eased substantially from a peak of 7% to 2.7%, but is still too high.
And some have already started cutting interest rates.
The Governing Council today decided to lower the three key ECB interest rates by 25 basis points.
Back home today, RBA Governor Michele Bullock left rates on a hawkish hold.
Inflation is still above central bank targets in many economies, and it is proving to be sticky.
Governor, you recently said that Australia remains on the narrow path of lowering inflation without a recession. If you had to hike rates again, does that risk knocking us off that path?
Well, I mean, that would be the decision we'd be taking if we were raising interest rates. We'd be making a decision about whether or not we really needed a higher rate to bring inflation back down in a more timely fashion. Again, though, the narrow path point is about trying not to knock us off that. And we are really, as I've said before, trying to bring the level of demand back down to the level of supply so that there aren't those inflationary pressures in the economy.
Today's decision came as no surprise to economists, with most predicting the bank would leave rates on hold at 4.35%, unchanged since last November.
I think the RBA probably should have increased rates a little bit further, probably closer to around 5%. And because monetary policy hasn't been tight enough, they're going to have to wait longer to be able to cut rates.
We think by year end it'll be very clear that we are tracking back towards that 2 to 3% target range.
While the RBA governor conceded higher for longer rates are hurting the economy, she said fears of a recession are unfounded.
They've got jobs, and I think that's really important for the future.
We have an unemployment rate around 4%. If we were in a recession, it would be jumping by 1 to 2 percentage points.
While the RBA didn't pull the trigger on a 14th rate hike, the governor said the board did consider it. She acknowledged the pain of higher rates is being felt unevenly across the economy, with some households bearing the brunt. Finder's head of consumer research, Graham Cook, says it's not just borrowers who are doing it tough.
The cash rate increases have actually had a more direct effect, a bigger effect on renters rather than mortgage holders. About 38% of mortgage holders are currently struggling to pay their mortgage, but it's about 42% or higher of rent payers.
What can borrowers be doing now to ensure they have the best rate?
With all of the financial stuff you're paying, check every couple of years if you're getting the lowest rate. With home loans, that's more important than ever now, because the interest rate on your mortgage is the most important number when it comes to your personal finance. That will cost you the most amount of money over the period of your life, because that's the highest expense. Reducing that number, even by a couple of percentage points, will make a big difference in the long run.
While the RBA is battling inflation, the big question for borrowers is when interest rates will start to come down. But economists are divided.
We think we'll see an easing cycle running at about a quarter percentage point a quarter. So 4 cuts following a November cut as well.
Realistically, it could even be as late as the middle of next year if we get a couple of quarters of inflation being relatively sticky.
A critical few months ahead.